The W-4 and the personal allowances. Basically, what we're doing there is the W-4 is an input to our payroll system. And the more allowances you put in, the less amount will be withheld from your paycheck. When you lower the allowances, if you need more money withheld, you can drop it all the way down to zero. And in fact, you can actually tell the payroll department, I would like more than that withheld. I'd like an additional amount withheld besides the single and zero status. Why do I want to have monies withheld? Because the IRS requires that you pay your taxes timely and as you go throughout the year, right? So you don't wait, yes, you can't just wait until April 15th and say, okay, I owe $4,500, I'll write a check now. No, can't do that. There are some rules, and the rules basically are that you either pay through withholding or through the system of estimated tax payments, which we'll talk about in a moment, either 90% of what you will owe for the current year or 100% of what your bill was for the prior year. So let's just put that down in specifics. All right, so let's just put some examples here so that you understand this a little better. So in 2016, my total tax was $15,000. That's my 2016 tax. And now I look into my crystal ball and when I actually compute my 2017 taxes, my 2017 taxes are going to be $20,000. I don't know how I got a crystal ball. I know that's exactly what I'm going to have to pay in taxes for 2017. So my withholding plus regular estimated payments must be either 90% of the 20,000, which would be 18, or 100% of the 15, which is 15. So I pay the lower of the two. I must pay the lower of the two or more in withholding plus estimated taxes in order not to be charged an estimated tax penalty. Okay? If I have an adjusted gross income of over $150,000, this so-called safe harbor 100% becomes 110%, so that the number would become in that case $16,500 rather than $15,000. And this works for both federal and it also works for the state of California, except that when you're over $1 million in California, the safe harbor goes away, and all you can do is pay. You've got to pay 90% at least of your current year. Yep.
Is the 150 paid for house like two earners or one earner, or is it just 150 paid?
It's joint. Yes. Yeah, so it's married filing jointly. It's the total, okay. The two of you. Okay. So now get to the issue of fellowships, for example. So with fellowships, no withholding is taken on a fellowship, right? So what you have to do is you have to make 4 quarterly estimated payments. They are on April 15th, June 15th, September 15th, and January 15th of the following year to comply with these rules here. I think the easiest thing for you to do for many of you to do would be to just do the 100% safe harbor, then you don't have to worry about it. And it's not like the money's going away. And if in that last quarter you do some figuring of your own and you say, wait a minute, Canellis is wrong. I'm going to be way over. Well, then don't make the last estimated payment. But the first ones, the early ones, I would be generous with those and make those. Yep. And this is very important. I would say this is one of the things that you all have to do is watch this and take a look at it in August, September kind of time frame and see how you're doing, see whether or not you're having enough withheld or whether you've made enough of these payments, probably before the September 15th payment, so that you have one, you can use the September 15th payment and the January 15th to somewhat catch up.